Imagine for a moment that you're running a thriving art gallery, a place buzzing with creativity, where you tirelessly connect incredible artists with enthusiastic collectors. You've just acquired a stunning painting, a truly unique piece, from an artist who, like many modern creatives, manages their business and markets their work through their own dedicated company.
Mm-hmm.
Confidently, you apply a special tax scheme, one specifically designed to avoid taxing the same artwork multiple times as it moves through the market, fully believing you're playing by the rules within the vibrant European art scene.
Right, you think you're covered.
Exactly. But then, the unwelcome notice arrives. A letter from the tax authorities. They're challenging your very understanding of who creates art and how it's taxed, all because the artist you bought from chose to sell through a legal entity, a company, rather than as an individual.
Wow, so your compliance suddenly gets questioned.
Precisely. And this isn't just some far-fetched hypothetical. It was the real-life dilemma at the heart of a recent pivotal judgment by the European Court of Justice. Okay, let's unpack this. Today we're taking a deep dive into this fascinating intersection of art, business, and complex European Union tax law. This case isn't just about abstract legal definitions or dry tax codes. It's about the practical realities for artists and businesses in a dynamic creative economy. And it really touched on a fundamental question about how we define creativity and commerce in the modern art world.
What's truly fascinating here is how the European Court of Justice, or ECJ, meticulously examines the spirit and underlying principles of the EU's value-added tax, or VAT, system. They look beyond just the literal wording of the law, to ensure it adapts to contemporary commercial practices.
Right.
Our mission today is to take this seemingly niche legal judgment, KC 4333 pour Galerie Karsten Greve et Ministère de l'Économie, des Finances et de la Souveraineté Industrielle et Numérique, and reveal its broader implications not just for artists and galleries, but potentially for other sectors dealing with unique goods like antiques or collectibles. You'll gain a clear understanding of what tax neutrality really means and why it's so critical for fostering a fair and competitive market. Our insights are grounded directly in the provisional text of that ECJ judgment, and we'll also be drawing on a comprehensive analysis of the ruling published by Vetabout, an expert tax insights platform.
So let's set the stage for this compelling tax dispute. At the heart of the matter are two key players whose business structures unexpectedly brought them into conflict with tax authorities. First, we have Galerie Karsten Greve, often referred to as GKG.
Okay.
GKG is an art gallery operator based in France. GKG functions as what's known in the tax world as a taxable dealer. This essentially means they're a business whose primary economic activity involves purchasing art with the specific intention of reselling it, making them subject to VAT.
Got it. A standard gallery setup.
Pretty much. And then we have Studio Rubin Gideon, or SRG, a company incorporated under UK law. This company was the business vehicle through which the renowned painter Gideon Rubin marketed his works.
Okay, so the artist is using a company structure.
Exactly. Now, this is a truly crucial detail that ultimately defined the case. Gideon Rubin himself was identified as one of SRG's two partners.
Ah, so he's directly involved. It's not some separate entity entirely.
Precisely. So, while SRG was a legal entity, it was directly and intimately tied to the artist whose work it sold.
And that distinction became the core of the problem, I take it.
You got it. The dispute itself began to unfold following acquisitions GKG made back in 2014. GKG acquired paintings from SRG through intra-community acquisitions, which, simply means purchases made from another EU member state.
Standard cross-border EU transaction.
Right. When GKG then resold these paintings to its own customers, it confidently applied a special VAT arrangement known as the VAT margin scheme.
Okay, let's pause there. Can you just quickly explain what the margin scheme is for our listeners?
Good point. So the margin scheme, basically, it's a special way of calculating VAT. It's designed to prevent art or certain other unique goods from getting taxed multiple times as they move through the market.
Right, avoiding that buildup of tax on the same item.
Exactly. This often happens when a dealer buys an item from someone who hasn't charged VAT on it, maybe a private individual, or, like in this case, potentially a creator under specific rules. So instead of paying VAT on the full selling price,
which could include tax already paid somewhere along the line.
Right. The dealer, GKG here, only pays VAT on their profit margin. That's just the difference between their selling price and what they paid for it.
That sounds like a pretty sensible approach, really, trying to avoid overtaxation on these unique items that might have a long history.
It does seem designed to make the art market flow more smoothly, doesn't it? But the French tax authorities saw it very differently during a routine audit of GKG.
Oh.
Yeah. They issued additional VAT assessments, essentially demanding more tax, because they questioned GKG's right to use this margin scheme for the paintings acquired from SRG.
And their reasoning was?
Their position was quite firm and, you might even say, rooted in a very traditional view of artistry. They argued that the margin scheme could only apply if the works were supplied by the individual artist, the creator themselves.
The actual person holding the brush.
Exactly. They asserted that a legal person, like SRG, simply could not be considered the creator of a painting. It was like they were saying, only the hands that physically paint the canvas can be the creator in the eyes of the tax law, not a company, even if that company is directly owned and run by the artist.
Wow, that's a very literal interpretation. It ignores the commercial reality, doesn't it?
It certainly seemed to. And that very strict interpretation had real consequences for GKG. Their initial appeals against these tax assessments were dismissed, first by the Administrative Court in Paris in November 2020,
Okay.
and then by the Administrative Court of Appeal in Paris in June 2022. And the Court of Appeal was explicit in its reasoning, stating that the creator of a painting could only be the artist who had painted it by hand, thereby flatly precluding SRG, a company, from qualifying under their interpretation.
So 2 French courts sided with the tax authorities' narrow view.
Correct. So GKG, understandably, wasn't going to just accept this. They lodged an appeal with the Conseil d'État, which is France's highest administrative court.
The end of the line in France, basically.
Right. And this is where the case truly became pivotal. The Council of State quickly recognized that this issue wasn't just about GKG's specific tax bill. It hinged on a fundamental interpretation of EU law that had implications far beyond one gallery in France.
Because the VAT rules are EU-wide.
Precisely. So they decided to pause their national proceedings and refer 2 crucial questions to the European Court of Justice for a preliminary ruling. This is a standard and vital mechanism in EU law, where national courts seek definitive answers directly from the ECJ on how to interpret EU directives.
And these questions were absolutely vital for the entire European art market and potentially other markets too, I imagine. What were they specifically asking the ECJ?
Well, the first question was direct and foundational. Does Article 316(1)b of the EU VAT Directive, along with related provisions, preclude a legal person, like a company, from being regarded as the creator of a painting for the purposes of the margin scheme?
So basically, can a company ever count as the creator for this specific tax rule?
Exactly. And then, if the answer to that first question was no, meaning a company could potentially be considered a creator for these purposes, then the second question became incredibly important.
Okay, what criteria then?
Right. It asked, what specific criteria should be used to determine if a legal person can be considered a creator? The French court even suggested some possibilities, like whether the company was subject to a special legal regime, or if the artist held shares in the company, or had a management role within it, or even if a substantial part of the proceeds of sale were transferred directly to the individual artist.
So they were looking for practical tests, potentially quite complex ones.
Yeah, it really shows the complexity they were grappling with. It wasn't just about one gallery's tax bill. It touched on a fundamental question about how we define creativity and commerce in the modern art world, where artists increasingly use business structures for, perfectly legitimate reasons.
Precisely. And this really demanded a deep dive into the very fabric of EU VAT law, which brings us to the core principles of the EU VAT Directive itself. These aren't just technicalities. These foundational principles are critical because they often guide the interpretation of specific rules, even when the wording might seem ambiguous or hasn't quite kept pace with evolving commercial practices.
Absolutely. The EU's VAT Directive isn't just a dry list of rules. It's built on grand principles designed to foster a truly unified and fair internal market across all member states. At its heart is the vision for a harmonized system where taxes like VAT don't distort competition or hinder the free movement of goods and services across borders.
Which is crucial for a single market to actually work like a single market.
Right. Think about it. If different countries applied VAT wildly differently, it would create unfair advantages or disadvantages for businesses, effectively putting up invisible barriers within the supposedly single market. The directive aims to eliminate these competitive distortions, whether at a national level or across the entire EU.
And this larger vision brings us to a critical concept within the directive: tax neutrality. This is a cornerstone principle of the common VAT system, and it's vital for understanding the ECJ's reasoning in this case.
Explain that a bit more. What does tax neutrality mean in practice?
Well, it dictates that similar goods and services should bear the same tax burden within each member state, regardless of how long or complex their production and distribution chain might be.
Okay.
Crucially, it means that economic operators carrying out the same transactions should not be treated differently in relation to the collection of VAT. So whether you're a small individual artist selling directly, or an artist selling through a company you own, or a large established gallery, if you're engaging in the same type of commercial activity like supplying a newly created artwork, the tax treatment should ideally be the same.
So it prevents penalizing or favoring businesses just based on how they're structured legally.
Exactly. It ensures fairness and prevents businesses from being penalized or advantaged purely based on their organizational structure or the number of steps in their supply chain.
Which flows seamlessly into the directive-specific approach for unique items like art, doesn't it?
It does. For goods like artworks, secondhand items, antiques, and collector's items, the EU recognized a unique challenge. Recital 51 of the directive explicitly states that a special taxation system, the margin scheme, was adopted to explicitly prevent double taxation and the distortion of competition as between taxable persons.
Right, that double taxation issue seems key for things that might get traded many times.
Absolutely. Imagine a beautiful antique painting. It might be bought and sold several times over decades, potentially across different countries, by individuals who aren't VAT registered. Without a special scheme, if VAT were applied at every taxable transaction, it could accumulate significantly, making the item prohibitively expensive and artificially hindering its trade. This principle aims to avoid that, ensuring fair treatment for those dealing in unique, often long-circulating goods.
Okay, so that context is vital. Now, let's get back to the VAT margin scheme itself, Articles 314 and 316. You said it's a derogation.
Yes, that's the legal term. It means a specific exception or departure from the general VAT rules. Instead of calculating VAT on the full selling price of a good, a taxable dealer like GKG pays VAT only on their profit margin. So again, it's the selling price minus the purchase price, and only that difference, that margin, is subject to VAT.
And what's the rationale behind this departure from the norm? Why make this exception?
Well, the court itself has acknowledged the inherent difficulties in determining whether VAT was previously charged on unique items like works of art. Think about it. An artwork might be very old, or it might have passed through many non-taxable hands over decades or even centuries.
Right, tracking that history would be impossible sometimes.
Exactly. Trying to prove whether input VAT was paid on a centuries-old painting would be nearly impossible. The margin scheme, by focusing the VAT calculation solely on the dealer's margin, reflects their actual profit on the sale rather than trying to track an often untraceable VAT trail that could go back generations. It simplifies things immensely for everyone involved, dealers and tax authorities alike.
Okay, that makes sense. So Article 316(1)(b) was the sticking point, the part about supply by creators or their successors in title.
That's absolutely right. That specific provision is the core of this case. It states that member states must grant taxable dealers the right to opt for the margin scheme when works of art are supplied to them by their creators or their successors in title. So the pivotal question in the Gallery Karsten Grieve case revolved entirely around whether that phrase could legitimately include a legal person, like a company, especially when that company is essentially the artist's business arm.
And just to be clear, the EU doesn't leave works of art vaguely defined either, does it? Annex IX is pretty specific.
Oh, incredibly specific. You're right. It's not just any picture. For tax purposes, Annex IX, Part A says it must be executed entirely by hand by the artist, explicitly excluding things like architectural plans or commercial designs.
So no technical drawings.
No. And it gets even more granular. Original engravings, prints, and lithographs must be executed entirely by hand by the artist, without any mechanical or photomechanical processes, and produced in limited numbers. Even sculpture casts are strictly limited to 8 copies with very few exceptions.
Wow. And you mentioned photographs earlier.
Yes, even an original photograph has a strict definition for tax purposes. Taken by the artist, printed under their supervision, signed, numbered, and limited to just 30 copies.
Okay, so the EU is trying to be very precise about what qualifies for this special treatment.
Absolutely. That level of detail underscores the very specific scope, highlighting just how precise EU tax law can be. It shows the deliberate efforts to create clear boundaries for a system designed to encourage specific economic activity, like the introduction of genuinely original art.
And mirroring this detailed EU framework, France's own tax code, the CJEU, generally aligned with it, right?
No.
Offering reduced rates and the margin scheme.
Yes, French law had provisions for reduced VAT rates for imports of art, typically 5.5%, and for supplies by creators or their successors at 10%. It also applied the margin scheme, following the EU directive.
But the problem, as we discussed, was the French tax authorities' interpretation.
Exactly. Their interpretation was that creator could only mean the natural person, the individual artist. And that interpretation set the stage for this high-stakes clash, pushing it all the way up to the European Court of Justice.
Okay, so now we get to the ECJ's deep dive.
Yeah.
How did they approach these questions from the French court?
Well, this is where their judicial approach really shines. The court didn't just passively answer the questions exactly as posed by the French Conseil d'État. Instead, they actually reframed the core question to get to the true heart of the matter.
How so?
Instead of getting bogged down in philosophical debate of, can a legal person be the creator, which is kind of abstract, the ECJ focused on the more pertinent operational question for the margin scheme's application. They asked whether the supply of works of art by their creator or his or her successors in title, acting through a legal person subject to VAT, falls within the scope of that provision.
So it's not, is the company the creator, but does the supply through the company qualify?
Precisely. It's a crucial distinction. It shifts the focus from identity to the nature of the transaction within the VAT system.
That's a really insightful rephrasing, isn't it? It demonstrates a crucial legal approach. Getting to the essence of the issue, addressing the economic reality of how artists operate today, rather than getting confined by a narrow literal reading of a single word like creator. So how did they go about answering this refined question?
To get to that essence, the ECJ consistently applies a well-established three-pronged approach to interpreting EU law. They examine a provision by considering, first, its wording, second, its context within the broader directive, and third, the objectives pursued by the rules.
Wording, context, objectives. Okay.
It's like a holistic view, ensuring the law works as intended in the real world, not just on paper.
So let's break down each of those. Taking the wording first, what did the court find in Article 316(1)b itself? Did the text forbid using a company?
Well, the court observed that the text does not specify the detailed rules for how creator supply works. It simply refers to the supply by their creators or their successors in title.
So it's silent on the how.
Exactly. Crucially, the court found that it does not expressly preclude a creator or his or her successors in title from carrying out such a supply through a legal person or such a supply from being carried out by a legal person.
So no explicit ban.
None at all. The commercial activity of transferring ownership rights, which is the supply of goods under the directive, can naturally occur through various legal forms, including a company. The directive simply didn't forbid it.
Okay, that covers the wording. What about the contextual analysis? You mentioned the margin scheme is a derogation, which usually means strict interpretation.
That's right, and the court acknowledged that. While the margin scheme is indeed a special arrangement and a derogation, meaning it should typically be interpreted narrowly, the court clarified that this strictness shouldn't go so far as to render the provision ineffective.
You can't interpret it so strictly that it breaks its own purpose.
Precisely. You can't be so strict in your interpretation that you actually defeat the very reason the rule exists. The interpretation must still align with the scheme's overall goals and, crucially, the fundamental principle of tax neutrality we discussed earlier. It's about finding that balance.
Which leads perfectly into the third prong, the objectives analysis. This sounds like where the real core of the argument lies.
It really was. This was the crucial part of the court's reasoning and where they really showed their pragmatic approach. They identified two primary objectives of the relevant articles that would be undermined by the French interpretation. First, and quite specifically, was the objective of promoting new art.
Encouraging creation and sales.
Exactly. Articles 103 and 316 of the VAT Directive aim to promote the introduction onto the EU market of new works of art, whether these are imported from outside the EU or newly created within it. This involves providing favorable tax treatment for their importation, their first supply after creation, and their first supply by taxable dealers who help bring them to market. The goal is clearly to stimulate the art market, not stifle it with narrow interpretations.
So it's about encouraging the creation and the flow of fresh original art into the market, making sure new talent and new works can reach collectors efficiently. What was the second objective they highlighted?
The second objective the court focused on was reducing administrative burdens. Article 316(1)b is also intended to simplify the proof and verification process for both taxable dealers and tax authorities regarding whether a work's purchase price included input VAT.
The paperwork nightmare we talked about.
Right. Imagine the sheer effort and investigative work if every single art piece needed a full, traceable VAT history back to its creation, especially for older or unique items that have passed through many hands, maybe even outside the VAT system entirely for periods.
Impossible in many cases.
The margin scheme, by focusing on the dealer's margin, largely sidesteps this immense complexity, making the system much more efficient and workable for all involved.
Okay, so promoting new art and simplifying administration. And this brings us to the so what? The practical implications. Why did the court conclude that excluding legal persons like SRG from this scheme would be so deeply problematic?
Well, the court stated it very decisively. They said that such a narrow interpretation, like the one taken by the French authorities, would fundamentally undermine the directive's core objectives, ensuring fiscal neutrality, avoiding distortions of competition, and promoting the introduction of new works of art onto the EU market.
Let's break that down because it's so critical. How would it violate fiscal neutrality?
Think about it. If creators supplied identical works of art, the transactions would be identical from a VAT perspective, whether that creator acted as an individual natural person or chose to operate through a company they own.
Same art, same type of sale.
Right. Treating them differently based solely on their legal form would result in inconsistent VAT rates for identical transactions. This directly contradicts the principle that economic operators carrying out the same transactions should be treated equally. It's like saying two identical coffee shops selling the exact same coffee should pay different taxes simply because one is a sole proprietorship and the other is a small, limited company. That's just not a level playing field.
That seems obviously unfair. And what about distortion of competition?
Well, following directly from that, it would create a significant distortion of competition between taxable dealers. Dealers like GKG would face different conditions for applying the margin scheme, depending purely on the legal structure of the creator they acquired the art from.
So a gallery buying from an individual artist gets a tax advantage over one buying from an artist's company.
Potentially, yes. A gallery buying from an individual artist could use the scheme, but a gallery buying from an artist who formed a company maybe for liability protection or to handle sales more professionally might not be able to. This unfairly favors one type of artist supplier or dealer over another, creating an uneven playing field in the market.
And perhaps most importantly, for the art world itself, how would it hinder art promotion?
By discouraging artists from using established, common legal structures for marketing their work. These structures provide essential benefits like liability protection, easier access to funding, or simply streamlining their business operations. Forcing them into an individual capacity just to get the intended tax treatment would inevitably impede the flow of new art into the EU market.
Because artists wouldn't want to or couldn't easily operate that way.
Exactly. Many artists today operate as professional businesses for perfectly legitimate reasons. Forcing them into an individual capacity for tax purposes would be a step backward, an artificial constraint on modern commercial practice. So if we look at what this all means, it's a clear message from the court. Tax law needs to adapt to how real-world businesses, including artists, actually operate, rather than forcing them into outdated or less efficient models.
This is precisely where the ECJ's landmark ruling steps in, providing crucial clarity and a significant course correction, isn't it? What was the final verdict?
The court's final interpretation was unequivocal. Article 316, or the V Directive, must be interpreted as meaning that the supply by taxable dealers of works of art, supplied to them by the creator or his or her successors in title, acting through a legal person, falls within the scope of that provision.
Wow. So they sided with the gallery. Essentially, using a company is allowed.
Yes, fundamentally. It was a huge validation of the modern art market's operational realities.
That's a monumental shift from the French tax authorities' original stance. But this wasn't just a blanket approval, right? The court stipulated two essential conditions for the margin scheme to apply in such cases. What's the first condition?
The first condition is attributability to the creator. The supply made by the legal person must be directly attributable to the creator or their successors in title.
Okay, what does attributable mean in practice here?
The court established a clear, pragmatic presumption. This condition is considered met, where the creator or successors in title have established that legal person specifically for the purpose of marketing the works of art created by the creator.
So if the company exists just to sell that artist's work?
Pretty much. So in the Gallery Karsten Grieve case, since Gideon Rubin was one of the two partners in SRG and the company's apparent sole purpose was to market his paintings, this condition would likely be fulfilled. The court effectively said, if the company is just the artist's sales vehicle, that's fine for tax purposes. It recognized the commercial reality of a single artist choosing to operate through a company for efficiency and legal protection.
And what's really telling is why the court chose this relatively simple attributability test.
Mhm.
And they didn't go for those complex criteria the French court suggested.
No, they explicitly rejected them. Things like requiring the company to be subject to a special legal regime or scrutinizing the artist's precise shareholding percentage or their specific management role or even how profits were distributed.
Why reject those? They sound thorough.
The ECJ reasoned that those criteria would create excessive burdens in terms of proof and verification. Imagine trying to apply those rules in cases involving collaborative artworks or artists who might have more complex company structures, maybe investors, or even multiple artists within one studio entity.
It would get very complicated very quickly.
Exactly. The court opted for a simpler, more practical attribution test that aligns with economic reality without bogging down businesses and tax authorities in unnecessary red tape and investigation.
Okay, so attributability is condition one. What's the second essential condition?
The second condition is equally important. The supply of those works of art to the taxable dealer must constitute the first introduction of those works of art onto the EU market.
First introduction, meaning it has to be genuinely new to the market in a VATs.
Precisely. This means there should be no evidence of a previous supply of that work of art, subject to VAT, constituting such a first introduction.
So it can't have already been sold under normal VAT rules within the EU before.
Correct. Furthermore, the legal person making the supply must have had the right to dispose of that work as an owner from its creation, or, in the absence of an earlier supply subject to VAT, at the time of that first introduction onto the EU market.
Okay, so the company needs to have owned it from the start, or at least before any other VAT-able sale.
Yes. This prevents the margin scheme from being applied inappropriately to works that have already been commercially traded within the EU's VAT system. It ensures the benefit is specifically for new art or art that hasn't yet entered the formal VAT chain through a taxable supply by someone other than the creator-successor.
How these two conditions work together.
Absolutely. What's fascinating here is how the court preserves the core intent of promoting new art and simplifying taxation while adapting to modern business structures without opening the door to unintended loopholes for previously traded items. It's quite an elegant balance.
So what does this landmark ruling mean for you, whether you're an artist navigating your career, a gallery owner, or maybe just someone interested in the intricate intersection of law and commerce? First and foremost, it provides crucial clarity for the art market. That seems huge.
It really is. Taxable dealers, artists, and galleries across the EU can now confidently apply the margin scheme when acquiring new works from creators who choose to market their art through legal entities, as long as these two conditions, attributability and first introduction, are met.
So less uncertainty, less risk of these kinds of disputes.
Definitely. It dramatically reduces uncertainty and the risk of costly tax disputes, allowing businesses to plan with much more confidence. It directly addresses the need for artists to use modern business structures for liability protection, easier access to financing, and streamlining their operations without incurring tax disadvantages.
And beyond the practicalities for the art market, you mentioned it reinforces broader EU principles.
Yes, beyond the art market, this judgment also serves as a strong reinforcement of fundamental EU principles. It powerfully reiterates the importance of fiscal neutrality and the avoidance of competitive distortions within the EU VAT system.
The court is sticking to those core ideas.
Exactly. It's a clear signal of the court's commitment to ensuring that tax rules accurately reflect economic reality and don't create unnecessary barriers or unfair treatment for businesses that are otherwise carrying out identical transactions. It reaffirms the spirit of a unified market over strict, potentially outdated, literal interpretations.
And here's where the impact might reach beyond just paintings and sculptures. You mentioned the margin scheme applies to other things, too.
That's right. While this case specifically concerned works of art, remember that the VAT margin scheme also applies to secondhand goods, antiques, and collector's items.
So this ruling could affect those markets as well.
Potentially, yes. The principles established in this ruling regarding creators or original suppliers operating through legal entities could very well have implications for those related markets, too.
Could you give an example?
Well, imagine a family trust established to sell off a collection of rare vintage automobiles originally owned by the family patriarch. Or think about an antique furniture dealer buying unique pieces from a private family company set up by the original craftsman's descendants to manage the estate.
Ah, I see. So if the company is attributable to the original owner-creator and it's the first introduction.
Exactly. This ruling suggests that dealers in these sectors could potentially apply the margin scheme in similar scenarios, fostering a more fluid and less burdensome market for unique items beyond just art. It suggests that the court's reasoning focusing on attributability and first introduction is broadly applicable to any scenario where unique goods are supplied by their original creator or successor through a legal entity for the first time into the EU VAT system.
So the ripple effects could be quite wide.
They could be. This ruling truly exemplifies the ECJ's pragmatic approach to interpreting law in a dynamic economy. It expertly balances a strict legal interpretation, acknowledging the scheme is a derogation with the broader overarching objectives of EU law, like neutrality and market function.
And it avoids making things overly complicated.
Crucially, yes. It avoids imposing complex administrative burdens, remember those suggested criteria for shareholding or management, while still upholding the spirit of the VAT Directive, which is to promote the introduction of new works and ensure fair competition. For many, this is an aha moment, realizing that tax law isn't just a static, rigid set of rules, but something that actually evolves or should evolve to reflect the real world, striving for practicality and fairness.
So there you have it, a deep dive into a court case that, on the surface, might seem incredibly niche, just about art and taxes.
Yeah.
But underneath, it reveals so much about the fundamental principles guiding fair competition and how tax law grapples with the evolving nature of creativity and commerce in our interconnected world. It's not just about rules on a page, but about how those rules are interpreted to ensure a level playing field for everyone, from individual artists trying to make a living to large galleries operating across borders.
It highlights the continuous evolution, or perhaps the need for evolution, in tax law to keep pace with how businesses, including creative ones, actually operate. The simplicity and practicality of the attribution and first introduction criteria finally established by the ECJ for applying the margin scheme in these situations. That's a significant and pragmatic win for the art market and potentially other markets dealing with unique goods.
Definitely. This ruling clarifies the past, but what about the future? It makes you think, doesn't it? Next time you admire a piece of art in a gallery, consider not just the artist's vision, but the invisible network of legal and financial structures that help bring that art to market.
That's a great point.
And how might the growing trend of artists forming larger collectives or corporate studios, or even the rapid rise of entirely new forms of digital art and NFTs, further challenge our traditional notions of creator and ownership in the eyes of the law?
Big questions there.
Yeah. And how will tax systems like the VAT margin scheme continue to adapt to these innovative expressions of creativity and their commercialization within the EU and globally? This ruling gives us a big clue about the court's guiding principles, pragmatism, neutrality, market function, but it also sparks new questions about the evolving future of creative commerce and taxation. What's the next frontier?